Time for the market analysis for this week, and we're joined by Edwin Chui, who is a senior research analyst at Dyer Blair. Many thanks, Chui, for joining us.
You're welcome.
Let's just begin by what could be happening with the markets. We're seeing the NSE 20 share index edging downwards from 3,000 points. Now it's at 2,889.
There's a number of things happening to the market. First is what everybody has been saying, that the emerging markets and frontier markets have been experiencing a sell-off by foreign investors for a couple months now. And that, of course, has to do with what's happening globally with respect to, the reversal now of hunt for yield because interest rates are going up in developed markets. But we also now have some factors in Kenya that have exacerbated the situation. For example, the failure of National Assembly to remove interest rate caps has given a bad signal to the market, because we do know that it's an issue that needs to be addressed, especially when you look at private sector credit growth, where it is at right now. And of course, the other issue is, the expiry of the IMF standby facility,
sure,
which a lot of foreign investors were looking at as, another source of confidence that we are keeping our books in order, that, the currency has a bit of cushioning in case things get worse. And of course, there is, the whole general sense that our fiscal position is not that great, and we do need to maybe start some form of restructuring.
All right.
Yeah.
So, Chui, you've really painted a deep picture of where we are as an economy.
Yep.
Does it mean it's all gloom and doom?
No. It's not all gloom and doom. It's a question of how we manage where we go from here. Okay. It's a question of what's the plan, and how clear is our plan, and how coherent it is.
But Chui, in all fairness, if you look at the economy right now,
yep,
the market fundamentals are really stable. Inflation is within target. Interest rates were capped. When you look at foreign reserves, we're not badly off.
No, I mean, we are not badly off, but you have to remember that last year was such a low base. Okay, so if you compare this year and last year, of course, we are not badly off, because nothing really happened last year. Okay, now you've talked about inflation. That's correct, but you know that inflation, especially the cost push element of it, is really a matter of food and fuel. So food is going to be okay, but on the fuel side, we have oil prices going up. Oil prices going up. We have the VAT element coming into play as well. And we know that fuel is so critical to just about every sector of the economy. And then you've highlighted reserves. Reserves are definitely good, and there is an argument for saying that that could continue because we have positive flow of diaspora remittances. We've got good agricultural performance, but we also have an element of debt financing, external debt financing that's coming up, especially next year, that is definitely going to have a negative impact on the reserve position. When you talk about what other factor, the currency, it's been stable for quite a while now, but there is a consensus view that it's somehow overvalued. And so, since we don't have the cushion, there's a bit of a scare factor that has come into play, because as an oil importer, as a country with a significant portion of external debt, as a developing economy, in the context of a global economy that is now starting to develop, from the development market standpoint, we have all these possible sources of risk of depreciation going into the future.
All right,
Yep.
Stu, you lost me there a bit, but let's move on. Let's talk about other numbers from the markets. We're seeing some of the top gainers this week. Very interesting stocks. Home Africa, it's one of the top gainers. It has really been not up there.
Yeah.
We're also seeing Everready. East Africa, the stock is up by 5.26%, Home Africa 8.33%. And these are not part of the quote-unquote blue chip companies.
They're not. And I think the only reason they are on that list is because the quote-unquote blue chip companies have fallen. Okay, so 6% of our week is really not that much of a gain, but it becomes again because the main companies that usually trade, over 10%, 15%, have fallen. And I think I have to say something there. So you do have about 60 plus listed entities, but only maybe 5 to 10 entities contribute to most of the market activity. Most of those entities are commercial banks, and then you have Safaricom. So if you have Safaricom going down and commercial banks going down, then you have the entire market really going down.
So Chui, is it the best time to buy or to sell?
For local investors, it's a good time to buy because for blue chip companies, the valuations are still high. Valuations have not really changed.
All right.
When you look at the banking stocks, the big banks, most of them had double-digit growth in profit at half year. That is going to be the case at full year, okay? So it's really time to buy. But now the market is pricing driven, not valuation driven, which really means local investors are going to buy if they are sure or persuaded that someone else will be buying from them. That someone else happens to be foreign investors. So if foreign investors are selling off and local investors are beholden to a quarterly reporting regime, then they don't want to have the little gain they have wiped off. So they sell as well.
All right.
Yes.
Many thanks, Edwin Chui. Always shooting from the hip. Thank you so much. Well, it's time for us to transition and just take a look at Markets 101 for this week. Well, it's time now for my favorite segment, and that is Question on the Street. Let's take a listen in on this week's question.
What does market turnover mean? And the second question, what does the term bull run and bear run mean in trading?
Market turnover is purely the total value traded in a given day. So you take the number of shares of a given stock times the volume weighted average price, and then you sum all those in total to get market turnover. A bull run is essentially a period of time where the securities in the market are either recording prices going up, or there's an expectation that prices will go up. And a bear run is now the opposite of that, a period of time when prices are either falling or expected to fall.
Well, many thanks, Chui, for those insightful answers. And indeed, I hope we've learned where we are as a market right now. And speaking of where we are as a market, let's take you down memory lane on a historical fact for this week. Well, many thanks for your valid company, and indeed we hope you've learned a lot, especially about what's happening in the capital markets from that insightful interview from Kerry Ann Makatiani. Well, from us and the entire team, keep tweeting, keep engaging with us on our social media handles appearing at the bottom end of your screen, and we'll definitely be sampling your views in our subsequent shows. From me and the entire team, it is bye-bye for now. Have yourselves a lovely viewing. Thanks.
You're welcome.